Most traders are obsessed with the wrong number. They chase 20% in a week, 50% in a month, 1,000% in a year. They look for the trade that will change everything, the setup that will finally make it worth it. And in doing so, they quietly destroy the one force that actually builds real wealth in markets: compound return. Not the kind you see on motivational posts or trading ads, the real one, the uncomfortable one. The kind that doesn't feel impressive in the beginning, but becomes unstoppable over time. Here is a fact that sounds almost insulting when you first hear it. If you can consistently make just 1% per day without blowing up, without giving it back, without increasing risk, you don't need genius-level analysis, insider information, or extraordinary talent to outperform most traders. And yet, almost nobody achieves it. Not because 1% is hard mathematically, but because it is brutally hard psychologically. Most traders don't fail because they lack knowledge. They fail because they don't understand what compound return actually demands from their behavior, their expectations, and their relationship with time. This video is not about hype, it's not about quick money, and it's definitely not about selling you the fantasy that 1% per day is easy. Instead, we're going to break down why compound return is the most misunderstood concept in trading, why it quietly destroys impatient traders, and why those who truly understand it stop chasing markets altogether. By the end of this video, you'll see why 1% per day is not a trading strategy. It's a psychological filter, and most people simply don't pass it. Early in my career, I made the same mistake almost every retail trader makes. I didn't think in terms of systems or long-term growth. I thought in terms of outcomes, big outcomes, fast outcomes. I measured success trade by trade, week by week, sometimes even hour by hour. And every time I had a good run, I immediately raised my expectations. If I made 5% in a week, I felt dissatisfied. If I made 10% in a month, I started thinking about 20. And if I ever had a strong winning streak, I assumed I had figured something out. That mindset nearly destroyed me. I remember a period where my strategy was actually working, not spectacularly, but consistently. Small wins, controlled losses, a smooth equity curve. On paper, it was exactly what most professional traders aim for. But emotionally, it felt slow, almost boring. And boredom is dangerous in trading. So I did what many traders do. I increased size, I loosened rules, I took trades that didn't fully qualify. Not because the market changed, but because my expectations did. I wanted growth to feel exciting. Within weeks, most of the gains were gone. That was the first time I realized something uncomfortable. The market wasn't punishing my lack of skill, it was punishing my lack of patience. At that point, I started studying traders who had survived for decades, not the loud ones on social media, but the quiet ones, the ones managing funds, trading proprietary capital, or running family offices where survival mattered more than storytelling. Almost all of them shared a similar characteristic. They didn't talk about monthly returns the way retail traders do. They talked about drawdowns, volatility control, and consistency. Growth was a consequence, not the objective. That's when compound returns stopped being a mathematical concept for me and became a behavioral one. It wasn't about making more, it was about giving less back. And that realization completely changed how I looked at 1% per day, not as a goal, but as a constraint.
The biggest mistake retail traders make with compound return isn't misunderstanding the math, it's misunderstanding the cost. When people hear 1% per day, they immediately turn it into a target, a number to hit, a benchmark to prove competence. And the moment it becomes a target, it stops being compound return and turns into pressure. That pressure creates a very specific chain reaction. First, traders start forcing trades, not because the setup is clean, but because they feel the need to make something happen. They stop waiting, they stop filtering, they start trading frequency instead of quality. Second, they subtly increase risk. Not dramatically at first, just a little more size here, a slightly wider stop there, a bit of leverage when things feel slow. They tell themselves it's temporary, just to speed things up. Third, they experience volatility shock. Small drawdowns feel unbearable because expectations were set too high. A 2% loss suddenly feels like failure, even though mathematically it's completely normal. This is where most equity curves die. Not from one catastrophic loss, but from a psychological spiral where traders try to protect an imagined future instead of managing present risk. The pain compounds faster than the returns. And here's the paradox. The traders most obsessed with compound growth are often the least capable of achieving it, because compound return requires emotional neutrality over long periods of time, while obsession creates impatience. There's also a deeper structural mistake. Retail traders calculate compound returns as if markets are frictionless. They ignore slippage, commissions, execution errors, psychological fatigue, and regime changes. They assume today's edge will behave the same way tomorrow, next month, next year. Professionals don't make that assumption. They assume edges decay. They assume variance will spike. They assume that periods of stagnation are inevitable. And because of that, they build systems designed to survive boredom, not dominate excitement. Most retail traders do the opposite. They design systems optimized for feeling good during winning streaks and then collapse under stress when reality deviates. That's the real pain behind compound return. It exposes every weakness you have as a trader: your impatience, your need for validation, your intolerance for flat periods, your inability to accept that meaningful growth feels unimpressive most of the time. And markets punish those weaknesses relentlessly. The turning point comes when you stop asking how to grow faster and start asking how to lose less. This shift sounds subtle, but it changes everything. Compound return is built on winning trades. It's built on asymmetry between gains and losses. When professionals talk about compounding, they're not talking about percentage targets. They're talking about drawdown control. Here's the core realization most retail traders miss. You don't compound because you win often. You compound because you avoid large losses consistently. Once you understand this, 1% per day stops being a goal and becomes a byproduct. At that point, your focus shifts to expectancy instead of outcomes. You start evaluating your strategy by asking a different set of questions. How stable is my edge across different market conditions? How sensitive is my system to execution errors? How does my performance degrade under stress? This is where smart money thinking enters the picture. Professional traders don't scale by pushing returns. They scale by stabilizing processes. They trade smaller than they can afford. They reduce variability before increasing exposure. They care far more about volatility than raw performance. When you study long-term performers, you notice something counterintuitive. Their best years don't look extraordinary on a monthly basis. What stands out is how rarely they have bad years. That's the real power of compounding. It's not acceleration, it's persistence. Once I understood this, my entire relationship with trading changed. I stopped measuring success by how much I made in a day or a week. I started measuring success by how little damage a bad period could do. 1% per day stopped being a promise of wealth and became a filter for discipline. If a strategy required emotional intensity, constant monitoring, or frequent intervention, it was incompatible with compounding. That realization is uncomfortable for most retail traders because it forces a hard truth. The path to growth is intentionally boring, and boredom is where most people quit.
To truly understand compound return, you have to strip away motivational narratives and look at how capital actually grows inside professional systems.
Compounding is not linear accumulation. It is the interaction between expectancy, variance, and time. Remove any one of these and compounding collapses. Most retail traders focus almost exclusively on expectancy. They ask questions like, what's the win rate, or what's the average R multiple? Those questions matter, but they are incomplete. Expectancy alone does not compound. Expectancy survives only when variance is controlled. This is where smart money thinking diverges sharply from retail thinking. Professional trading operations, prop firms, hedge funds, CTAs, design strategies with one primary constraint: maximum acceptable drawdown. Returns are secondary. The system is reverse engineered from risk tolerance, not profit ambition. Here's why this matters. Compounding works exponentially only when capital is preserved during adverse periods. A 50% drawdown does not require a 50% gain to recover. It requires a 100% gain. That asymmetry is lethal. Smart money understands that avoiding deep drawdowns is mathematically more powerful than chasing higher returns. This is why many professional systems target what retail traders would consider mediocre returns. 10 to 20% annually with low volatility is considered excellent if it can be repeated consistently, because consistency is what unlocks time, and time is what compounds. Let's look at a concrete case. Consider a proprietary trading desk running a medium-frequency futures strategy. The system has an expectancy of 0.3 R per trade, a win rate just above 50%, and strict risk limits capped at a fraction of 1% per position. On paper, this doesn't look impressive. There are retail traders claiming 10% days with similar setups. But here's the difference. The prop desk's strategy is designed to survive regime shifts. When volatility spikes, position size automatically scales down. When liquidity dries up, trade frequency drops. The system accepts flat periods without intervention. It is not optimized for excitement. It is optimized for durability. Over time, that durability produces a smooth equity curve. Not because every month is profitable, but because losses are contained within predictable boundaries. This allows capital to stay in the game long enough for small edges to accumulate. That's compounding in reality. Now contrast this with the typical retail approach. Retail traders often run strategies that perform extremely well in narrow conditions. High leverage, tight stops, aggressive scaling. During favorable regimes, returns look spectacular. Equity curves go vertical. Confidence explodes. Then conditions change. Spreads widen. Slippage increases. Correlations shift. And because the system was never designed to degrade gracefully, losses accelerate faster than gains ever did. The trader responds emotionally, adjusts rules midstream, and compounds mistakes instead of capital. This is why 1% per day is misunderstood. It's not a daily outcome. It's an annualized effect of disciplined behavior. When professionals talk about daily targets internally, they are not referring to realized profits. They are referring to process metrics, execution quality, rule adherence, risk normalization. 1% per day only compounds if it emerges from a stable process. There's also a crucial time component most people ignore. Compounding does not reward intensity. It rewards exposure. Not market exposure, but exposure to time while remaining solvent. Every day you stay in the game without significant damage increases the probability that small advantages will express themselves. This is why many long-term traders deliberately undertrade. They pass on opportunities not because they don't see them, but because those opportunities don't align with their risk envelope. Their edge is not in prediction, it's in selection. From a smart money perspective, the real question is never how much can I make today, it's how much can I afford to lose without impairing future opportunity. Once that question becomes central, behavior changes automatically. Trade size shrinks, frequency drops, decision-making slows, emotional spikes flatten, and paradoxically, performance stabilizes. That stability is the soil in which compounding grows. 1% per day is not impressive because it's large. It's impressive because sustaining it requires eliminating nearly every destructive habit retail traders rely on for emotional satisfaction. It requires letting time do the heavy lifting, and most people are not wired for that.
If compounding return is built on preservation rather than acceleration, then application must begin with behavior, not tactics. The first principle is risk normalization. Most retail traders size positions based on confidence. Professionals size positions based on damage tolerance. The question is never, how good does this trade look, but how much can this trade hurt me if I'm wrong? Compounding requires that no single decision has the power to meaningfully impair future opportunity. That means position sizing must feel almost disappointingly small. If a loss changes your emotional state or forces you to trade differently afterward, the size was too large. The second principle is volatility compatibility. Every strategy has a volatility profile it can survive. When markets move faster, spreads widen, correlations tighten, and execution deteriorates. Smart money does not fight this. It adapts by reducing exposure. Retail traders often do the opposite, increasing size to make up for slower conditions. That behavior kills compounding. Your strategy must be aligned with the current market environment, or you must step aside. Flat periods are not failures, they are part of survival. The third principle is expectancy over streaks. Retail traders judge systems by short-term results. Professionals judge systems by long-term expectancy stability. A system that wins frequently but collapses under stress does not compound. A system that survives drawdowns without behavioral degradation does. This requires brutal honesty in review. If you need constant adjustment to stay profitable, you don't have a compounding system, you have a reactive one. The fourth principle is emotional neutrality. Compounding demands that wins and losses feel roughly the same, not because outcomes don't matter, but because emotional spikes distort decision-making. When trading becomes exciting, it becomes dangerous. Professionals aim for predictability in process, not stimulation in outcome. If your best days feel euphoric and your worst days feel devastating, compounding is impossible. Applied correctly, these principles don't make trading more impressive, they make it quieter, slower, more restrained. And that restraint is exactly what allows time to work in your favor. The real secret of compound return is not mathematical, it's psychological. 1% per day is not difficult because markets are efficient. It's difficult because human behavior is not. Compounding forces you to abandon urgency, ego, and the need for constant progress. It replaces excitement with discipline and replaces ambition with patience. That's why so few traders ever experience it. Not because they lack skill, but because they refuse to trade in a way that feels small, controlled, and unremarkable for long periods of time. They want results before they've earned stability. If you remember one thing from this video, let it be this. Compounding does not reward intensity, it rewards endurance. The traders who last are not the ones who push hardest. They are the ones who protect their downside so effectively that time has no choice but to work for them. If you're serious about building that kind of edge, one that survives boredom, volatility, and your own psychology, then this channel is built for you. Subscribe to Staro Trading, share this video with someone who's still chasing fast returns, and leave a comment answering this question. Do you think your biggest problem in trading is strategy or impatience? Because until you answer that honestly, compounding will remain an idea, not a reality. Master yourself. Master the markets.